Thank you. So welcome to this analyst meeting. So welcome for those present, and thank you for making the effort on the Friday afternoon. And welcome to the online participants to the CIEL analyst meeting. So let's start straight away. So in the room today, there will be Jérôme, Marc, and Hélène, and myself presenting. So the agenda is to go, I'll take you through the result highlights. Jérôme will take you through the group financial results. We'll do the cluster reviews. Hélène will do a good deep dive on healthcare. Marc and myself will take you through the outlook, and we'll have time for the Q&A. So as a result highlights, firstly to start with, we have a growth in revenue, which we didn't see last year. So this mainly comes from the textile operations, which is now generating good growth in turnover. We are seeing good momentum on the textile, finance, and healthcare, which is a very important part of our strategy. And we are grateful to see good momentum on the share price as well over the period. When we look at the key highlights for the clusters, hotel and resorts, we've done the split of Sun with Sun Life and Riveo. So firstly, unlocking quite a lot of value on the market, which represents about 28% of market of value creation, but also it enables us to have a good focus on Sun Life strategy and Riveo strategy, and we'll cover it later. Textile, we see good momentum and strong demand in our Indian operations. On the finance side, Jérôme will talk about it, but we have appointed a new CEO at the level of Bank One, where we want to optimize the performance of a bank. On the healthcare, Hélène will cover it, but very strong operational performance across the regions. Property, we have started all the infrastructure work at Fairness, so the project is coming alive, if I put it that way. And on the agro side, there's a drop in sugar price on the world market, but good momentum on the property sales in Mauritius. So from a results perspective, so I've talked about the turnover. From an EBITDA perspective, we have a drop in EBITDA. Jérôme will cover it, but basically it's linked to Riveo, where we had the Shangri-La renovation. It's linked also to the property, where we booked exceptional sales last year, and then all the Mauritian government-led salary increases that we faced in Mauritius. So this led also to a drop in profit after tax. Also, what we are seeing in the share of our agro business, the share of the results, Jérôme will cover it, is lower than last year. And also we have the climate corporate risk tax, which represents about 140 million rupees of additional tax. So leading to a group attributable profit of 1.1 billion for the 6 months. Group EBITDA margin at 19.3%. Group earnings per share at 0.67 cents. The gearing still very healthy, despite a slight increase from 25% to 28%. And a group net asset value per share at 12.39. So we'll take you through the figures, but we'll take you through the clusters to explain to you the strategy and where we think that we're moving into the right direction and creating momentum for the future and for the semester to come. I'll hand over to Jérôme. Thank you.
Okay, thank you, Guillaume. Good afternoon to everyone. Thanks for making it. So in terms of the group financial highlights, so we have first the revenue, as Guillaume said, we have an increase of 6% during the 6-month period, and mainly led from 3 clusters of a group. We have the textile, which has performed quite well during this period. We've also got the finance cluster with BNI in Madagascar, and the healthcare have been the star performers for the 3 months. Hotel and resorts, we had good performance on Sun Life, but on the Riveo front, like Guillaume mentioned, we had the closure of one of our hotel, the Shangri-La Hotel, for 3.5 months, which has therefore impacted on the contribution to the revenue of the group from hotel and resort cluster. Moving to the next slide, what's interesting to see is where we generate the revenue, where CIEL gets its revenue from. So we've got 3 geographical regions, Mauritius, Africa, which comprise of mainly Madagascar and Uganda, where we have a healthcare facility, and Asia, where we are in textile, not only in India, but also in Bangladesh. So we can see that there's been a drop on the Mauritian front at the expense of Africa. That's because we have, in fact, moved our formal shirt factories, we closed it here in Brazil, and we move it to Madagascar. So we're increasing our production capacity in Madagascar, and also the better performance from the healthcare. The Ugandan facility has done well and has contributed to this, and also, of course, BNI, where we're going to see later on, has improved its revenue line. In terms of currency mix, which we normally give at the CIEL analyst meeting, I think it's important. We're quite proud of this because, I mean, the risk diversification as far as our currency mix is, as you can see, it's well spread. And we have today almost 50% of our revenue in hard currency, which is a big asset of the group, meaning the 25% in dollar, 17% in euro, and 7% in GB. So we're quite well diversified, as you can see. We operate in India, where we do sell part of our shirt production. And in Madagascar, it's the BNI contribution to the top line. And in Mauritius, it's mainly, among others, the Bank One and the healthcare facilities. Now, going back to the EBITDA, and we have an EBITDA waterfall from last year to this year. We were at 4 billion last year. We're down to 3.6 this year. As Guillaume mentioned, two big impacts on the group EBITDA is the hotel and resort cluster. Again, Shangri-La closure and a bit of a slowdown on the luxury market in Riveo. Therefore, impacted also by increasing costs. I mean, all our operations have been impacted by high inflationary costs, not only on wages, but also in general on all the raw materials and other costs. So quite a big impact coming from hotel and resort cluster, and also on the property. Like you mentioned, we had a one-off sale in our non-core portfolio at fair level last year in Q2, and therefore this year we haven't materialized a property transaction. The next property transaction we look at next financial year with the delivery of Farm Living, which is the first phase of the Fairney development project. And then we have, of course, potential this drop has been mitigated by improved performance from textile, where there has been a good cost management despite the increase in costs, healthcare, and to a lesser degree, finance. Now, moving on to our earnings. This is the PAT, so it's before the minority interest. We can see that finance is the biggest contributor to the PAT line of the group with 911 million for the 6 months. Then comes very close the hotel and textile with 490 million for the period and 427 million for the textile, representing approximately 20%, for the hotel 22%. While the healthcare and agro contribute just short of 200 million rupees, healthcare has contributed 196 million to the profit of the CIEL group. While agro, we are down from last year, and I will come back to it, at 178 million. On the property front, there hasn't been major sales during the year. We've got Evolutis, which is our mixed-use property fund, which has a positive contribution, but it's pretty limited, as you can see, when you compare it to the group contribution. Now, we thought it'd be interesting also for the analysts present today to see where we generate. We say where we generate our revenue. Now, where we generate our profit, and we can see on the pie chart on the right that compared to last year, again, we've shifted from Mauritian base, where we had more than 50% generated in Mauritius. It's down to 31%, while in Africa, we've increased the profit contribution from 32 to above 50%. And this, again, is mainly BNI good performance in Madagascar, Ugandan operations in a healthcare, and the mere fact that we have shifted production capacity from Mauritius to Madagascar in the former shirt business. And we can also see the good performance of the Asian operation, which has contributed 16% to the group profit, which is mainly our expansion and the good profitability of our operations in Africa. So coming back to the profitability, now we're going to see a pie chart showing the profit attributable, therefore after the share of minority in the profit of each entity. And we can see that at this level, textile, because we own 100% of our textile operation, so there's no change in textile. It's 437, 32% contribution, while finance is down because to 347, higher than last year. But when we saw the previous graph, it's because there's quite substantial minority interest in our investment in BNI, and we're sharing also 50% of our profit at Bank One with a partner from Kenya. And the other clusters, healthcare contributing 9%, 121, Agro 178%, 178 million, sorry, 13% of our portfolio contribution to the profit. Now, interesting slide, which we put a lot of focus in terms of management time, and we ensure good discipline in the group. It's the free cash flow generated, because it's our capacity to leverage in terms of getting cash to make new investment, to bring down indebtedness. So we can see on the two columns on the right that we have a slight shortfall in cash generated from our operations for the 6 months, from 3.1 billion to 2.7 billion. But where we use a lot of cash during the 6-month period is on the working capital requirement. And if we look at the breakdown per cluster, we can see that most of the working capital requirement comes from the textile sector, and textile sector is currently opening new factories. We have opened a factory at Delapo in India, which has eaten up a lot of working capital requirement to get started. And that has, among other things, created a substantial utilization of working capital. We can also see that hotel and resort, because we're just after the peak season of December, so debt is quite high in our books. And the healthcare also had a big utilization during those 6 months. Not only those in terms of impact in terms of working capital, we have also got the maintenance capex, which has increased from 486 to 811 million for the period. And there also healthcare and hotels cluster are heavily investing in terms of new technology, new equipment for the healthcare, and making sure that at the hotel fronts, our inventories are to the standard. So this is leading us to the indebtedness of the group, which was at 11.1 billion in June when we released our year-end figures. Now we up to 14.2 billion rupees. So 3 billion rupees increase, representing an increase in our gearing to 28%, but 28% being, we believe, well commensurate to the industry norm. And compared to our peers, we are we're quite sort of low leverage compared to others. It leads to a group EBITDA, a net debt to EBITDA of 2. Our target is lower than 3. We were at 1.5, so yes, there has been an increase, but that I think is still well commensurate, and we can support such an increase. Now I'll pass on to Mark for the portfolio review and the share price. So Mark, the floor is yours.
Thanks, Jerome. So just in terms of the CIEL portfolio, so as you can see, we've grown from 24.7 billion up to 25.5 billion over the last 6 months. CIEL Textile, we only value once a year, but as Jerome and Guillaume touched on, there's been a significant focus strategically to really drive future organic growth in India. And we're certainly seeing that coming through with the whole China Plus One demand for manufacturing in India materializing. In terms of the drivers of the change in valuation, so our strategic intent was to split from a hotel and resorts perspective, Sun Life into one cluster, and Rivio into our branded resorts business. And that's really going to be positioned as a property investment vehicle going forward. So very happy to see the recognition of the market in that, and the valuation uplift that we've got. We, as a group, a key future growth driver for CIEL is healthcare. And in terms of future growth, what we're looking there is expansion into East Africa, as we articulated at the last analyst meeting. And we've taken a position as CIEL that we want a larger exposure to the healthcare cluster. And you can see there we've acquired a further 10.44% stake in CCIL. So we strongly believe in the future growth, and good luck to Helen and her team in executing on that. Yeah, then the other pieces are like the valuation uplift from Bank One and BNI, and the quite a big decrease in healthcare from the VWAP declining over the period. In terms of the share price, so very happy to see that outperformance has led to a 29% increase up to 31st of January 2025. So significant outperformance versus the markets and our peers. And really happy to see the quality of the MCP report that's been released. So hopefully you've all read it, and hopefully you can see what the target share price is there. But very happy with the performance to date, and hoping to see that continue in the future.
Thank you. So we'll take you now through the hotel and resorts. So we'll just cover the main highlights and key strategic intents. So what you will see on the figures, so we talked about it already. So Jérôme covered it. So it's quite a important drop in the PAT, but less from an EBITDA perspective. So if we look at what we wanted to do is to break it down between Sun Life and Riveo for you to understand better. So what you will see is from Sun Life perspective, still a very healthy performance. The PAT has been impacted because of the taxes and also some Forex gain that we had last year. But what you will see, and you don't see it on the graph, it's very good KPIs from a net margin perspective or EBITDA margin perspective. So Sun Life, very well-run business. We are very happy, still very healthy from a KPIs perspective. On Riveo, so a drop due to Shangri-La renovation. And I must say, let's say pick up post-renovation, which is behind plan to date, but we're working on it with Shangri-La, and François and the team very active on it. And we're very confident for the future performance of Shangri-La. It's work in progress. And what we have seen as well is a drop in the performance of Four Seasons. It's an aged asset. So we are going in renovation on the 1st of April. So what's important for us, difficult to push an hotel which is going to go in renovation because you're phasing out the bookings. Having said that, very good relationship with Four Seasons. We are very bullish about it going forward. And so far, very promising budgets for the upcoming year. So our strategy on Riveo is very clear, very focused. So we know exactly in which direction we are going. And François and the team very much focus on Riveo. So what I think it's important to note here quickly is really the inflation environment that we are operating in Mauritius. So we are very happy to see strong focus on productivity from the teams, really to make sure that we go up the EBITDA margin. We put the EBITDA margin back up to the level that it was. So that's an area of focus for us. We want to accelerate the property development. So on Sun Life, we've done La Pirogue Residences. On Long Beach, we are also working on a project with another developer, and François talked about it in the analyst meeting. On Riveo, we are also looking at the property development next to our hotels. So this is one area that we are really pushing to create value. And then two elements which are important for us is customer experience. We believe that if we're going to keep the excellent performance of Sun Life and Riveo, is about customer experience and the Mauritian savoir-faire. So a lot of focus on that, and also sustainability. I think that Sun Life is leading the way in terms of sustainability. Now we want to make sure that our customer see all the efforts that we are doing and recognize all the efforts being done by the Sun Life team. So now from a textile perspective, what's good is the growth momentum. So being in the revenue, EBITDA, and the PAT. And what I would like to say is that when you look at this PAT, 60% of it comes from Asia. And I would say 75% of it comes from the shirts of Asia. Very, very strong demand. So in Asia, consolidation in the region. Jérôme talked about it. We moved some capacity to Madagascar for competitiveness challenges. But India is really the driving and the growth motor in that respect. So we are really focusing on driving growth and operational excellence. I would say that in India, we have more orders than our capacities, but we are very careful in the way that we approach it. It's not growth at any cost. It's controlled growth to make sure that we retain very good margins out of it. And then we are turning around the next cluster, which is still loss-making, but in the momentum of turning around. So next year, we expect the next clusters to start contributing to the profitability. So these profits are impacted by a loss coming from the next cluster that we expect to reverse as from next year. Digital and sustainability initiatives are key for us. This is what we are driving. And then talents are very important. And what we are doing a lot today is leveraging on India. Now, one element that you need to be aware is that the region is very much dependent on AGOA, not fully, but partly. So this is something that we are following very closely because it's coming to an end in September 2025. It has not been renewed yet by the US. So this is something that we are following closely. But generally, growth in India, very interesting prospects in India, and consolidation in the region, which is in line with what we communicated before. So from a property perspective, so turnover, we are seeing a growth coming from Evolis, but also on Ferney operations. Having said that, on the EBITDA, it's being distorted by the property sales that we had to book fully last year. We have not booked the property sales. Jérôme explained about it. So, and then we have also the development cost of Ferney, which is impacting the performance of Evolis, which is netting off the performance of Evolis on these figures. So what I would like to say, Evolis, very strong occupancy. We just bought a new building in Arsenal. When we bought it, it was 50% occupancy. We have moved it now at more than 90% occupancy. So I would like to say that I would say that on the portfolio, we're at 95% plus of occupancy. So yielding the portfolio well. And we are still looking at other assets that we can incorporate to the portfolio. And on Ferney, what's important is farm living in Ferney has been a success. We've started the infrastructure and we'll start the delivery. We hope in August 2025. So we will start booking the profits on that as from next year. And we have a number of projects which are ongoing on Ferney. So I'll hand over to Jérôme for the finance and happy to take questions on the clusters after.
Thank you, Guillaume. So now moving to the finance cluster, we can see a sustained performance, improved performance in this cluster, mainly coming from BNI. During the period, Bank One result has been at par with prior year. As Guillaume mentioned, we've been having a transition in terms of management, with Sunil Ramgopin taking over in October. So he's taking his place in a company and making sure that he builds his team. So it will hopefully bring results very soon. So the increase in revenue is mainly led by BNI. The EBITDA margin has been under pressure. I mean, the cost of funding has increased. So our EBITDA margin, as you can see, is slightly above what it was in the corresponding period. But in terms of PAT, we had a good performance, less IFRS 9 provision on the loan book because the loan book hasn't grown that much. Madagascar is quite a challenging country, especially right now, whereby we have had increase in the cash reserve ratio. The regulator is putting VAT on interest. So trying to curtail inflation at the expense of the growth of the economy. So despite this challenging environment, BNI is the number one bank. And what's interesting to see is that the compounded annual growth rate in the banking sector, the banking penetration rate is still low in Madagascar. So if we're one of the leaders in a market which is growing, our capacity to build profitability is there. So we strongly believe of maintaining our presence and with our partner Action, who is a local partner, who is in fact helping us a lot on the digital front, because as we say, one of the focus areas for this year is to come up with digital tools after the roadmap we've defined. And Action Group, being the leader in telecommunication there, is of great support. And we have a great, young, talented team in the group at BNI to make it happen. Now, we've seen also some banks like Société Générale pull out of Madagascar. So this is also giving opportunity for us to seize and capture more market size. So we are following closely all of this transition in the banking sector. And of course, as I say, we're also looking at opportunities in the fintech. We have invested in investment in Uganda in small fintech entities, and we are following closely the evolution in the East African region of opportunities in this area. But the two main contributors to the cluster profit is BNI and Bank One. That's where the focus is. Midco, which is a fiduciary company operating from the fourth floor here, the results are mitigated. There's a lot of competition in this field, and we are trying to move really to AI, generative AI, to help us to become more efficient, because the attrition rate in this industry is quite high. Therefore, it's a challenge to make sure that we build profitability on the back of the operations we have. So that's on the finance front. Now, on the agro, as we mentioned earlier, Guillaume mentioned that the contribution for the 6 months is lower than prior year. We can see last year we had a contribution to the group profit for the 6 months of 308 million, which is down to 178 million for the 6 months. And it's coming from both fronts, from the African front on Miwa, whereby last year we had market condition which was excellent in Kenya. Sugar price was at its high, and we had a very good production. Fortunately, this year the sugar price has gone considerably down for the first 6 months. It's picking up right now, but we have had a distortion because we have had a shortage of cane delivery from farmers to the mill, because there was a sort of lack of maturity in the cane. So since we don't control the outgrowers there, we have had a shortfall in production, which unfortunately might be difficult to catch up before the financial year end, which is June. So we expect a shortfall from Kenyan operations. On the other hand, Tanzania is doing very well. We are probably going to be close to the record year in terms of production, and that's a good sign, because last year we had some operational difficulties. But in Tanzania, we have had a lot of imported sugar in a year of election, and the market has really gone down in terms of market price, and the market is flooded with imported sugar. So in the first 6 months, we have had to build stock because we didn't want to sell our sugar at a very low price. So we've got a huge stock of sugar, which hopefully in the next 6 months, we will start to sell. We probably won't be able to sell all our sugar by June this year, this financial year. So the challenge in Kenya is more production, and in Tanzania currently it's more the market price, the market price, the sugar price, and the capacity to unload our sugar on the market. RTO Mauritius is also this year lower sugar price. Last year was a record price of more than 31,000 rupees per ton. We're down to 24,000 this year, lower production. So we expect a lower contribution this year compared to last year from the agro cluster. Well, the market dynamics, where we should focus, it's really firstly in Mauritius, it's the special sugars, because that's where we get the premium on special sugar we produce, that the Demerara, Muscovado, and it helps us because it gives us a contribution of more than 3,000 per ton of sugar. So we've got a premium of 3,000 rupees over and above the raw sugar price. So that's where we want to focus. That's where we want our industrial assets to be good at and try to capture market share in this field. Now, inevitably, as you all know, most of the sugar estates in Mauritius are shifting towards property. I mean, it's a case like Dera, Omnicaine, and Medine. And we also, at RTO, have got big projects. We have the Anaïta IRS, which is completed now, and Anaïta Beauchamp, which is at the back of the IRS project, is underway. And they are selling a lot of agricultural land. There is a dynamic in the market, and the absorption rate is quite high with quite good results and good feedback. So we're really pushing to try to mitigate this shortfall from the sugar price, which has gone down. We're trying to increase the sale of these agricultural non-core land, because these are lands which are not mechanically harvested. On the Kenyan front, maybe one good news which is coming up is that the government is coming back with its privatization program. I mean, it has been on and off for the last 20 years, but lately it's back on track. So this gives the possibility for Transmara, which is in a very fertile region, to potentially increase its production capacity. Whereas in Tanzania, the short-term government policy of giving import license is really the challenge we're facing. And we hopefully, after the election, that won't be the case, and that we'll be able to sell our sugar at a much improved price. So I think that covers the main highlights of the finance and agro cluster. I will pass on to Hélène. So like every year, we invite a special guest for a deep dive for the half-year results. So last year, I can't recall, we had what, textile. So now this year was finance. So this year we're going to give the floor to Hélène to have more explanation. And please, make use of a presence to ask your questions, because as Guillaume has stressed, this is the future of CIEL Group, lies a lot on the good performance of healthcare. Sorry.
Bon après-midi tout le monde. Mieux. Ouais. So half of the year, we managed to achieve a 20% growth on our top line, which we are quite happy knowing the competitive environment in Mauritius, and also very well driven by Uganda, who is doing well. Also from an EBITDA margin, a good growth. We need to keep in mind that this includes the relativity adjustment on the salary plus the 14 months. We have taken into account all the 14 months in December, so it's all in those numbers. We are talking about 77 million additional just on those two aspects in the first half of the year. And a PAT also, which is growing, and the fact that we have created a separate company for CLAB help us also to manage our taxation at group level. Maybe on the outlook, what I suggest, let me go in the deep dive because we will repeat ourselves quite a lot on this, the market dynamics. Here, I think what is important to understand is the constant growth year on year since we really took over from Fortis. If you can recall, Fortis was managing our hospitals in Mauritius and in Uganda up to 2019, and we took over. And since then, we have been growing at a double-digit year on year. EBITDA also, and from a PAT perspective, we saw a peak during the COVID period, which I think was explained in the past, thanks to CIEL, because we did a lot of PCR testing at that time with reasonable margins. So this was very exceptional. You can see also the growth. What is good is to see that both countries are growing from a top-line perspective and an EBITDA perspective, with an acceleration in EBITDA since a few years. We have done fundamental changes in Uganda, be it on the hardware, but also on the software, and it's really bringing results. A few important KPIs, our EBITDA margin. Apart from the spike during the COVID, we are now trading at an average of 20%. I need to say that from ecosystem perspective in healthcare, the best in class will be around 23%, 24%, I would say. Large scale hospitals group like Life Healthcare, like all the Indian ones, will be at a higher EBITDA margin. And our aim is to really reach that kind of EBITDA. We are smaller, but we are gaining in economy of scale. So I really believe that with the right things that we are doing, this should be achievable. And we have, I would say, maintain a PAT margin of around 8%, which is also among the top, I would say, worldwide, but yet recently impacted about the, due to the HR cost, but also a lot of investment we did, which is affecting the depreciation, obviously affecting the PAT, but this will pay in the coming years in any case. So for the one who don't know really CIEL International, so we are positioning ourselves as a regional group now, East African group, with Mauritius. So CIEL International owns 67% of our Mauritian activities. And we have all the clinical hospital part here. We also created CIEL International. So we have moved under the biotechnology scheme of Mauritius, all our lab activities under one company now. Before it was under CIEL Mauritius. So this has really allowed us to benefit from some incentive and also to refocus the team on the growth. And we are very happy with the results of CIEL International. Dencare, we recently acquired a dental company in Mauritius and also launched our dental strategy in Uganda. We have 14 chairs now in Mauritius dental, and we have 17 chairs in Uganda. And this is also a new area of development we want to focus on. And then we open our cancer center for the one who visited, just to see the kind of investment we have. I hope for nothing else. We are very happy to have partnered with some French partners in equity on in Croix. So Croix is based in Floréal. Then we have 93% in CIEL Uganda. In CIEL Uganda, we have IHK, IMC, and CIEL, and Dencare is managed under the IMC. So IHK is really the hospital operation. IMC, it's all the clinics. We'll see in the detail of a bit after. And then we have launched CIEL 3 years back. And then we entered Madagascar a year ago. We acquired a medical laboratory chain there. We have 3 medical laboratories, and we just opened last week our first medical center in Tananarive. This is a bit to give a better understanding of our history. We are not new, but I need to say that over the last 5 years, there has been an acceleration in the development and in the fundamental changes in the group. So you can see that since we really position ourselves around 2019 when Fortis left, we created the brand CCare and we created the lab, the brand C Lab, and from there we accelerated our growth. A lot of projects, which means a lot of investment. We invested since 2022 2.5 billion rupees into CCare International as a group. And this is giving us really the firepower for the coming years. Also, we invested in quality certification. We really think that we can differentiate ourselves from a quality perspective, patient experience perspective. So we are the only hospitals group in the East African region to be accredited by CHKS. It's a UK accreditation. They accredit the NHS hospital in the UK. And in Uganda, we have a South African accreditation. Operationally, we are in 3 countries, but we have opened an office in Kenya. I'm not putting it here because we don't have any operations yet in Kenya. We have 3 main hospitals, 2 in Mauritius that you know, and we have 1 in Uganda. We have 24 primary care clinics. So for the one who knows CIEL Tamarin or CIEL Grand Bay, that would be 2 in Mauritius, and the rest is in Uganda, in fact. We have 29 medical laboratories and 55 collection centers. The difference between the two, a medical laboratory is where a test is performed on site. A collection center is where the blood is taken, but the sample is sent to a main laboratory. So for example, in Mauritius, we have a lot of C-Lab across the island that you may have seen, but they are collection centers. We only have laboratories in Welkin, Dane, Grand Bay, and Tamarin. The rest are collection center. In Uganda, why we have more? It's because the country is way bigger and it's very difficult to make the sample travel without affecting the quality of the results. From an inpatient perspective, we do admit around 40,000 patients a year. We have now more than 500 beds in our group. We do almost 1 million consultations a year in Mauritius and Uganda together, which is for me something we have not yet tapped into it from anonymized data. We have a lot of medical data, which we have not yet, I would say, been able to create value out of it. But this is something really important. And it also gives us, I would say, a lot of understanding of how it works and a lot of economies of scale when we see so many patients. Emergency is also something which will attract further patients to our hospital, and we have around 2,700 employees. Mauritius, you know Mauritius well, so I won't go really in all details, but I think what is important in that slide is to see our spread across the island. And I think this is what really we are trying to do, is that almost everywhere in the island, a patient can go to a CCare facility. Obviously, this is a lot of C-Lab everywhere, but this is helping, and based with those C-Lab, we may improve, I would say, our services in a proximity area in the island. We also have our clinics in Tamarin and Grand Bay, and we are adding new rooms also in Grand Bay soon. In Uganda, it's a bit similar. The country, we are talking about 50 million people versus 1.3 in Mauritius. But here again, it's our spread. No one else in Uganda is spread like us. Let's say we have 22 medical center clinics. Our next competitor has 7. So there's a huge gap between us and our competitor, and our capability now to open new clinics. Now we are used to it. We know exactly how it has to be done. We understand the financing part, the digital part behind, because obviously behind it's about control, stock control, and if you have the right IT ecosystem behind, it makes everything way more easier. And our hospital, you can see, has been rebranded, and we also invested quite a lot of money to revamp the hospital. And since we did it, it works very well. We are very happy about the results in CIEL Uganda. Maybe to give you a kind of a market potential, here in Mauritius, the entrance penetration is estimated at 28% of the population. In Uganda, it's 1.5% of the population. Here in Mauritius, our turnover is 55% cash. In Uganda, in our hospital, we are doing only 35% cash. And in our clinics, we are doing 13% cash. So now that we are solid, we have done our rebranding. The challenge now will be to get those cash patients to come to us because the market is huge. In Madagascar, as I told you, that's very new. So I think you are the first one seeing the pictures. So we are in Tana, in Ivat, Tamatave, and Majanga. Tamatave and Majanga are mainly medical laboratories. But when we will understand the market, be well positioned there, we will obviously open medical center in those cities. Our vision is to be the most trusted healthcare partner in the region. In this sentence, I would say trust is a super important word for healthcare. Obviously, this is where we put a lot of emphasis, patient experience, quality, trust of the doctors, etc. But also here is partnership and region. We see ourselves as an East African player and not only as a Mauritian player. Today, 2/3 of the activities in Mauritius, 1/3 is in Uganda, is in East Africa, but East Africa is growing faster than Mauritius. So our ambition is to double the size of our cluster in East Africa. We want to have the right culture and the right values, ethics, quality. I talked about it. Obviously, our clinical teams, how to attract the best doctors, how to attract the best nurses. We have also opened a nursing school. Well, it's not yet nursing, but it's phlebotomist and healthcare assistant. And we are working with the Nursing Council to get our accreditation for nursing school. And we are also doing a lot of continuous education with the doctors. Very important to attract them. Data, BI, we invested, I would say 4 years back into a BI team. And I think we are quite ahead of our competitors in the region from a data understanding and a data management. A lot to do more, but I think we have put all the good structure around to be able to deploy it quickly. Digital, which is a bit different than data in our jargon. Digital is really the app, the patient app. I hope you all have the patient app, the doctor app, and all the software that are really bringing additional value addition in radiology, for example, and operating theater, etc. And then something which we really believe in is replicability. We want our model to be replicated in all the country we go. We think that the fact that we have been able to replicate those 24 clinics in Uganda successfully, it's like excellent playground to do it now in Kenya, in Rwanda, in Tanzania. So we invest a lot in our operational excellence, our standard, our IT system, so that we can replicate quite easily while managing the risk, because we all know that investing in those countries, there's a high risk element, and we feel that by controlling the ecosystem, we can go faster. I'm not sure you want to go through the list, but this was just to explain where the 2.5 billion rupee went, and also the fact that it's behind us now. So maybe big numbers. Since FY23, let's say 2022, we added in Mauritius 80 beds. And I'm not talking about the cancer, I'm not talking about all the other things. 80 beds, it's a hospital. So let's say our competitor, I won't nominate the competitor, has less than 80 beds in the hospital they have it. But we did it within our walls. So by marginal investment, we managed to add those additional beds, except Grand B. This represent for Mauritius around 32% increase in bed inventories. In Uganda, we also added 80 beds, and this represents almost 80% additional beds inventory over the last 4 years. So it was a lot of project, not easy all the time to make it happen, but we managed to do it. So what really pleased me is that now we have a tool to deploy, which is very exciting. Well, at least for me, sorry. All the new projects, just to give you a feel of who we are. Also the positioning, even in Uganda, we try to position ourselves as a top tier, you know, in healthcare. Even if your market, let's say a CT scan, where in France, a CT scan may be charged 20,000 rupee. In Mauritius, the same CT scan will be charged 10,000 rupee. And in Uganda, it will be charged 5,000 rupee, but the machine costs the same. Okay, so that's the reality of our markets, etc. But we want to pitch at a higher level because this is where we feel we can really create the value addition on our investment. This is Uganda still. You can see a bit of all what you are doing, and Madagascar just below, very new. Yeah, let's keep that slide. So maybe a few numbers that were not listed. Debt to EBITDA is below 1. Good gearing, which give us a lot of hope on our ability to deploy for the future. We want, as I told you, to double our size in East Africa. That's the reason why we open our office in Kenya. Operational excellence, we talked about replicability, we talked about standards, we talked about efficiency. We really need to push that EBITDA margin at least 3 points above what it is today. And then also to make really Mauritius as a medical hub. And also, I would say, potentially Uganda as a medical hub for South Sudan, for Rwanda, because we are better equipped than what they are. So basically, these are the pillars of what we will be working on in the coming years. Voilà, je pense que j'ai tout dit. Est-ce qu'il y a des questions?
Voilà. Very exciting. I think that well done to Elan, because I think that there's a great team, very clear strategy, a model in Uganda which is working now, very clear. So I must say that from a CIEL perspective, we're very excited about Uganda, about CK, and it's doing very well. So from an outlook perspective, so I'll ask Mark to join me as well. Basically on the core business, we said at the last analyst meeting, we're focused on EPS growth, and I'll come back to that, but also to narrow the discount to now, because we believe in the valuation of our portfolio. From a hotel and resort perspective, we are really strengthening operational focus on Sun Life and Riveo. So we want to be the best in class in driving value for the customers, but also all the KPIs, margin, and having good yielding businesses. From a textile perspective, we're really focusing on India and realizing that growth and the potential of India. Finance, I think that Jérôme talked about Bank One, that we see a lot of potential and we want to maximize the potential of Bank One with the new leadership team. Healthcare, strong focus. There's been a lot of focus on growth or the projects that Elan mentioned, but now very strong focus on operational excellence from a customer satisfaction perspective, patient satisfaction, doctors relationship, but also operations at large, which is very well managed and handled. And then property, what we didn't see in the figures is that ultimately a few years ago, property was maybe not really present in CIEL, but today, even if we don't see it in the figures, we are unlocking value from our property assets in the group. So I'll hand over to Mark for.
Thanks, Guillaume. So from an adjacency growth perspective, healthcare, as we've mentioned before, expansion to East Africa. It's expanding operations in Uganda and looking at potential opportunities in Kenya. And hopefully from Helen's presentation, there's a huge amount of confidence from your side as we do in that strategy. Hotels and resorts, unlocking more value through Rivio and the real estate developments. And then property, the Fene development, as Guillaume took us through in terms of the farm living projects and the ecotourism projects that we're looking at Fene. From a new frontier growth, so new opportunities that we're looking at outside of our current core businesses. Finance that's really focused on East Africa, fintech investments and collaborations. And then from a manufacturing perspective, this is focused on India. So leveraging our Indian experience, manufacturing expertise that we've got there, really looking at, in particular, medical device manufacturing that we can potentially partner with for opportunities in India. So a very exciting space that we're looking at there, and hopefully we can communicate more to you in the future. Thank you.
Thank you, Mark. So the strategy that we presented to you, I think that during the year-end results, very much aligned to that, very much focused on results and operational excellence, but also new growth drivers that we are setting for the future. So I think that's it, and we are ready for questions to Elan on the healthcare. I think it's an important part of the CIEL, and then on the other clusters and the performance as well. Thank you.
Any questions from the room? Okay, I've got one question from online in the meantime. When are you expecting to pay the dividend for CIEL Group?
Yeah. So from CIEL perspective, what we agreed with the board is we'll pay the dividend on a yearly basis, so which is validated on the June board, and paid later. So it's a yearly dividend based on the performance, and maybe to share what we've seen is with the COVID. You know, we are in a very volatile world, so we want to free cash flow is important for us. Cash is important, and we pay dividend from the cash that we have.
Thank you. Any other questions from the floor? Everybody wants to go home. It's Friday night.
So thank you very much.